if we have an s-corp, when we have that meeting with our accountant or our CPA and they're trying to explain to us what it is that we're taxed on, that can be a little bit of a confusing conversation. If we were like, I only took $50,000 of income out of the company, why am I being taxed on $150,000? Personally, I've found the accountants that I've worked with in the past have struggled to communicate how this works. So we're going to go through a diagram. We've simplified the process to show you really how taxable income flows through an S-corp. W-2 compensation would be the owner was basically taking a paycheck out of the company. They have a weekly or biweekly paycheck that they're taking from their company that they own, and their taxes and all those things are being deducted out of that check, correct?
Yes, and run through an actual payroll processor to where you're going to have your W-2 at the end of the year, 941s, you've got these ongoing payments, not sort of the colloquial way we would describe a salary as just, okay, this is what I transferred from my business bank account to my personal. So this is being run through true bona fide payroll.
Okay, so something like Gusto, somebody's running it through Gusto,
Yeah, exactly.
being processed. Okay, now the other side of that coin, which we don't have pictured here, would be the scenario that you brought up, where somebody is transferring the money, or moving it from the corporate bank account, to a personal bank account.
Yeah, absolutely. And that's where a lot of the confusion will come into play, is that people will have the discussion of like, okay, well, your S-corp made $200,000 this year. And so that's what you're being taxed on. People say, no, 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 no. I only took $60,000 out of the company. I only took $60,000. That's the only income I have. It's not 200,000. I only made $60,000. And what we're getting into now, and what we'll show on some of the other charts, is that that's just not the way that the IRS looks at it. The IRS is taxing you based on the profitability of the business, irrespective of if you drew all the money out of it or kept every bit of it in. So in this scenario that we're talking about, where this person is 100% owner of this S-corp, what they're getting taxed on is that $100,000 net profit that they will receive by a K-1, and then the $50,000 in their W-2. So they're getting hit with $150,000 of taxable income. Doesn't matter how much of that profit they chose to distribute from the S-corp and how much they chose to retain in there.
Okay, so just to be, so when you're having the conversation with your accountant or your CPA, and they keep saying it's a flow through, right? It's a flow through organization. That's what they're meaning, is the profit, this net profit here that we're talking about right here. It doesn't matter if that stayed in the company bank account. That profit is flowing through to you.
Right, exactly. All that income or loss is flowing through to you individually, and that's where the taxes are being paid. If you compare that to a major, like a Fortune 500 publicly traded company, in those setups, and those are taxed as C corporations. In those setups, the corporation pays tax on whatever the profitability is, and then when you distribute it, then that's a totally separate taxable event. That's what they talk about, the double taxation. So I think that's part of the confusion, is that for big companies, if you receive dividends, that in and of itself is a totally separate taxable event, and that triggers additional taxable income.
Got it. That makes a lot of sense, and I think it makes it a lot more clear. So while we're on this topic, right, we just have the W-2 compensation of $50,000 as an example. A lot of people who own S corps are not taking their income that way, right? I would probably, and tell me if I'm wrong here, I'd probably say that the majority are simply, probably not frequently running payroll for themselves, maybe a little bit, but I'd say the majority are probably doing that, distribution type transfer from their business account, the S corp, to their personal account. Is that accurate?
Yeah, absolutely. And for compliance with an S corp, you're required to run a W two for yourself with a reasonable salary.
Right.
And there's different things of what the sweet spot would be for that and just for your qualified business income deduction. But in both cases, normally people that's not the money you're living off of. A lot of times people will have their withholding jacked up really high or their retirement plan distributions, and that's being funded from the salary they have. So for me, I do not take, and I haven't for years taken an actual net check on my W two because all that's going to income tax withholding, retirement, and retirement. So that's not what I live off of. That's a mechanism to make payments to the government mostly. But what I'm actually living off of, exactly what you're talking about, is owner's distribution. So that's the way people are paying, if not the majority, a large portion of the compensation that they're taking out of the company to fund living expenses. Most of that's through owner's draws.